Good day, fellow investors. I recently received an email asking me two key questions that I think are the questions also you think about. So the first question is, okay, I have some money. Is it the time to invest now, or should we wait for a crash? Of course, if you invest your money now and then there is a crash, you will feel stupid and you will lose your money likely. However, if there is no crash and you don't invest and stocks keep going higher, higher and higher, then you again feel stupid because you haven't invested. And then, of course, the question leads, okay, how can we predict whether there will be a market crash or not? And then that leads to the question of the economy, low interest rates. Can we have a Japanese scenario with 20 years of low interest rates, money printing, the government buying stocks that will put a floor to the stock market and to, let's say, this time is different and things will never change? Let's discuss. I'll make 3 scenarios to put all in perspective, and by the end I'll give you a real answer on how investing works so that you can make the right decisions for yourself. I'm not sure you will like my answer, but over the last years of experience and listening to long-term investors, it's actually the only answer. So if you enjoyed this video, if you like the value you get from it, please click that like button because it helps the YouTube algorithm, and consider subscribing if you haven't. If you subscribe to this channel, if you learn about investing, I'm very sure that over the next decade, 2 decades, 3 decades, I'm sure that yours will be the earth and everything that's in it. And you will see what I mean by that till the end of the video. So let's start by discussing the current market. Is it a bubble? Will there be a crash? Is that an opportunity if it crashes? Or the market will keep going up and there is no crash? Let me tell you immediately, nobody knows. If we just check Warren Buffett's performance over the last 50 years, there have been 4, 5 times, so approximately every 12 years, where Berkshire's stock fell between 30 to 50%. The great Berkshire, the great Warren Buffett, had its stock price plummet like there is no tomorrow. So can we say, okay, will there be no crash tomorrow or stocks will keep going up? That's something not even Buffett knew in history. So how do you expect that we know it now? If you are looking for that answer with YouTube videos, then you are fooling yourself. And I don't want you to fool yourself. So let's back it up with data, put it into scenarios, and then come to a decision-making situation. All ends up to market timing or time in the markets. Of course, if you can avoid investing at market peaks like 2008, you avoid painful declines of 40%. But then you have to nail the bottom, because if you don't nail the bottom, what usually happens if we don't account for inflation, then stocks keep going up, up and up. And if you are waiting, you might miss on this upside. There were a lot of people that in 2010-11, with all the budget deficits, the situation in Europe, etc., said, okay, this is too expensive, the market is too expensive, Berkshire is too expensive, and yes, it fell 20%, only to explode on the upside later. So timing the market is very risky. Not being into the market is also risky because, okay, cash, we know that cash is losing money. We made a video at the beginning of the year, so that's always the question. Should we invest now or not? And that question will remain. It will depend on your strategy, how much money you should invest and how much not. That depends on you, and you have to put things into perspective so that you can make that decision, not whether the market will go up and down. Then you are just betting on something. You might get lucky, you might get unlucky, and if you get unlucky, then you have to see how it affects on your life. Because we might see something like this. This is the Argentinian stock market. So in 2012, it was around 3,000 points, and now it is at 50,000 points. Over the years, it really went from 1,000 or less to 50,000. So why does this happen? This is a big market crash, even if it doesn't look like it, because the Argentinian peso lost value. So we have an inflationary crash. And to protect yourself from inflation, you need to own real businesses, real assets that can, by pricing power, protect yourself from inflation. So we don't know whether we'll have a real crash, 50% down in real terms, or we'll see negative real returns, but extremely positive nominal returns. So that's also something that I wish I knew, but as I don't know what will happen in the future, I have to be ready for anything. That's the key when it comes to investing. This is the Dow Jones historical chart adjusted for inflation in current dollar levels. Let me show you this. This is from 1966. It peaked and then it took till 1995, 30 years to reach zero real returns. In the meantime, in real returns, it was down also 75%, 66%, something like that. This is possible, this is something that can happen, and you have to see, okay, what if this happens in real terms? How can I survive it? How much money to put into the stock market, into stocks, into businesses? Because if we don't look at inflation adjusted, if we look at nominal returns, then it took, what was this, 15 years at zero nominal returns, and then it really spiked up. But this was just saved because it offered some kind of inflation protection. Later, and as interest rates went down, then also the stock market went up, up, and up. But apart from dividends here, in real terms, till 1990 something, in real terms, you would not get much else. And then one strategy is very simple. Peter Lynch, and if you look at his book, we have made a summary of his book on our free course, free investing course, link in the description below. You see that he was always 100% invested, so that solved all his issues. So the customer, his clients, needed to make a decision, okay, how much money do I want to be invested in the stock market and how much not? And the answer there is purely 100% personal. Investing is personal. Investing is about your money, and you have to see how much to allocate to various vehicles, to various life needs, and then you can make the right decision. Whether the market will go up or down, trust me, nobody knows. Of course, being fully invested would be great if we have low rates forever. If we check interest rates, this is the 10-year US government bond yield, and we can see that we are at very interesting lows, historical lows, 1.15%. That's really insane, especially compared to historical times with 8%, even, what is this, 15.8% on the 10-year Treasury yield. But this shows you also that things can change. We had very low rates 1960s, 50s, 40s, then very high rates, then very low rates, and now, expecting that this will stay forever is risky because you don't know what will be the case in the future. If we look at historical interest rates, so you can see how we have had long periods of very stable and, let's say, low rates between 2% and 5%. Similarly, also after the Great Depression, after the current financial crisis, we had, what is this, 40 years of very low rates, and then suddenly they lost control of it in the 70s and boom, it exploded to 15%. If this happens, we have seen what happened to stocks when interest rates started to go up from 8,000 points to 2,200 points in real terms. That is 75% down. And also here it's small, but if you look at this, look at the stability of the interest rate in the 1960s. It reminds us of the stability of interest rates over the last decade. Very low and stable interest rates. Later it changed, but you cannot know when it will change. I wish I knew, and also if we listen to smarter people than we are.
I am so afraid about democracy getting the idea that you can just print money to solve all problems, and eventually I know that will fail. Who knows when money printing runs out of control?
It's simply clear. We cannot know. So we have to invest in an environment where it is impossible to know. And therefore you have to think, okay, what can happen? We're going to go through the scenarios now. If this, that, or that scenario happens, how does it affect me personally? Can I handle it? Can I survive? Can I end up better? If you can be that, end up better, whatever scenario comes along, then you are an investor, and then you can allocate that money to investing even now. So let's discuss the macro situation and the market situation with our friends Bill, Warren, and Charlie. Great names. So scenario one, Japanese scenario, let's say low interest rates forever for the next 10 years, low inflation, plenty of liquidity, plenty of money, low unemployment. We are now in a COVID disruption, but we had extremely low unemployment just a year ago. Everything beautiful, everything great. And what does Warren say about it?
It looks like nirvana. It looks like we found the promised land where we just, essentially money doesn't cost anything, and you can print lots of money and have full employment and no inflation. Now, I think stocks are ridiculously cheap compared, if you believe that you're going to have the 3% interest. 30-year bonds makes sense.
That's a big if, though.
Well, that's what makes going to work interesting.
Thanks, Warren. So that's what Warren says. Stocks are ridiculously cheap if the current environment prevails. However, we have Bill and Warren saying things that will make you think a little bit.
Well, the interest rate is like gravity, and all these valuations are dramatically affected by it. I'm amazed at how high the valuations are if you look broadly.
Warren, you share those concerns?
Yeah, I probably could not have conceived of a world as recently as 10 years ago. I would not have conceived of a world where you would have full employment, 5% budget deficits, with actually the probability of those rising from that level, and at the same time have the long bond at 3%. I would have said that couldn't happen. And then people now, you have this modern monetary theory, which there's no question you should borrow, any country should borrow money in its own currency. I mean, that is not like it's some great discovery or something that's been announced, but
No, it can be overdone.
yeah, and that's the point. I mean, that hasn't solved anything. Just to say, well, it's much safer to borrow money in your own currency, but the convergence of these factors would have seemed impossible to me, and generally, if I feel something is impossible, it's going to change over time. I don't know in what way, but I don't think we can continue to have these variables in this relationship.
What if things change? What if inflation comes slowly creeping, is under control? The Fed said we'll let inflation to 3%, 4%, so that the long-term average goes around 2 to 3%. Everybody needs inflation to lower the burden of deficits. More inflation, higher taxes, easier to pay off the debt. So think also about that. So what if that happens? If interest rates slowly go up to meet that inflation to 3-4%, price-earnings ratio, as Bill says, are very high now, so we'll go lower and we might see a longer-term crash between 50 and 30%. If it's a good economy, I assumed inflationary also earnings, so earnings growth there, let's say market stocks go down 30 to 40%. Higher rates, those companies that are very risky, have no earnings, need to raise a lot of capital with higher rates, might get really destroyed. So everything is different depending on the business, but that's scenario 2. I would say we could see a decline between 30 and 50%. That is, again, possible. And you have to know what you would do in that scenario. Scenario number 3, and here we talk Charlie Munger, and here we have seen what happened with the Dow going down. How much? 75%. Similar situation was in the 1930s, and that's also something to keep in mind, that it can happen. So, because we are printing money, Charlie says we can't do that forever, and sooner or later it will be very, very costly. Of course, Charlie is a 96-year-old fart, so who wants to listen to him? Or he has 96 years of experience when it comes to financial matters. So it's up to you to decide to whom to listen.
Who knows when money printing runs out of control? And at the end, if you print too much, you end up in something like Venezuela.
You're not suggesting that happens anytime
No,
soon.
but I don't like the idea. And both parties, politicians, say, what we've learned is we can print all the money we want.
Right.
We don't have to raise taxes, we just print.
Scenario 3, bad economy, bad interest rates, bad inflation, and we can see real terms stock crash 50, 60, 70%. Perhaps if we have really an Argentina, Venezuela scenario, as Charlie said, we might see them even go up 100%, but nobody would be happy about that. So when Charlie says 90% down, it is possible, but depending whether we talk about nominal or real terms. And now we come to what to do. Well, I don't know what will happen. My crystal ball broke, so I'm sorry about that, but I can tell you that one of these 3 or even a 4th scenario will happen, especially as investing is something that you do over 40, 50 years. So I guarantee you we will see a lot of different things over the next 40, 50 years. High rates, low rates, inflation, recessions, crises, viruses, volcanoes, whatever, you name it. We will see a lot of that. Perhaps even Martians attacking us. We don't know. We will see. As Warren said, that's why it's interesting to go to work every day. However, we have to invest in a way that we are ready. And Warren says it somewhere 2010-11 letter to shareholders. He quotes Kipling poem, If. If you can keep your head cool when the market crashes, if you can keep your head cool when everybody else is losing theirs, if you can trust yourself that owning businesses is the way to go long term, that you will reach the highest potential, the highest returns over whatever happens by owning businesses and reinvesting those dividends and building up wealth by owning businesses, then the world will be yours and everything in it. But you just have to accept this can happen and therefore allocate whatever you have to those possibilities so that whatever happens, you end up well. Warren Buffett is sitting on $102 billion in cash because he knows what can happen, and if that happens, he wants to be ready. So he is deliberately lowering his returns now with 20% of his balance sheet in cash to have the optionality of doing better in the future. So you have to see what fits you best. Don't have a binary mind. Everybody has a binary mind. Oh, I have to invest. Okay, let's sell everything I have. Let's sell my mother and invest everything in the stock market. No, you don't need a binary mind to invest. You need, okay, this is all what can happen. We have the scenarios. How can I survive and end up better no matter what? If you have that mindset, if you own businesses, if you're a business owner and not focused on stock prices that will go all the time up and down, up and down, up and down, then you are an investor. And then you are very welcome to subscribe to this channel for the very, very long term. And then we will try to look at pricings, irrationalities around the globe, around the markets. We'll try to avoid this. We'll try to avoid, of course, we are in a new paradigm, delusion, greed, pushing everything up. We'll try to balance things, balance risks, and that's investing. The key is that you try to do your best, accumulate wealth in the form of businesses over time, dividends, reinvest those, and whatever happens, end up well. Thank you for watching. I'm looking forward to your comments. I know you might not like the answers that I gave you, but trust me, usually what you don't like is most beneficial for you. Thank you, and I'll see you in the next video tomorrow discussing top 5 S&P 500 stocks and their valuations so that you can put things again more and even better into perspective.